Awesome.
I mean, I guess we're running out of time here, and I don't know, Fabi, if there were some questions you wanted to get in, but I'm curious how you think for some of these newer assets, particularly things like crypto, how how options, implied volatility surfaces and everything, and liquidity is evolving for those, and where you see some opportunities and how they fit into this picture of kind of convexity and tails.
Yeah, I'll speak less generally just because we have short time, and I'll talk more specifically, right, to the environment we're in and what that likely means. Obviously, how you structure trades is very dependent on the environment you're in. But important to note that, let's start with the macro. We're at, record valuations by lots of metrics, equivalent to when I came into the business. I came in 98, 2000 was similar valuations. If you asked me in 2001, 2002, will we ever see that kind of a bubble in U.S. markets again? I would say, after the NASDAQ dropped 92% and 95% of tech businesses went belly up, I would have said, no, I don't think we make that mistake again in my lifetime. Well, here we are, right? And I know we're not here to talk macro, and I'm not. And the reason I mention that, though, is not because of the valuations, because valuations are not a good metric for, like, as we talked about at the beginning, about predicting whether the market's going up or not in the next month, the next year, the next quarter, 10 years. Okay, it's a relatively good predictive tool on a decade basis. But what that can tell you is certain things about the distribution, and for all assets, not just crypto. We can get to crypto very specifically as well. But the reason bubbles happen, and the reason, to your point, we don't get a lot of 8% returns, we get big returns or we get big declines, is there are structural effects that come into the market that buy the market. These are the passive flows that Mike Green and others talk about. These are the Von and Charm flows that I talk about from the carry trade, that is put versus call. These are buybacks. These are the government and the Federal Reserve incentivized to continue to provide liquidity and push assets higher. Okay, there are plenty of other things I can get to, but these things operate day to day, regardless of macro or valuations or anything else. So that's one. Two, as things get to a decade-long predictive, like, okay, this is not a good time to be long assets historically, right? Based on if you just look at Schiller PE, like the next decade-long returns is on average 0 to 1%, right? So, and I'm not the only one talking about this. Like,
I've been in the same camp, Goldman.
Yeah, I don't know how you couldn't be in the same camp, right? Like, it's just so obvious. So, but that's the problem, right? Because at the end of these things, and this was true in 98, before we saw a 50% rally in markets and then a 92% decline. The problem is institutions know this isn't structurally a good time to be long, so they get short. Institutional investment was at the 0th percentile coming into the summer, 0, and is now at the 15th after they've massively deleveraged and had to, pretty much because of the squeeze that's happening. As that happens, right? This is a voting machine. More buyers than sellers drives market up. Well, if you have net short positioning in the marketplace, what do you think is going to happen? Those, especially if you're in a period where those structural flows are very positive and they keep pushing, right? It doesn't matter where valuations are. There's more buyers than sellers, and this is why squeezes happen. This is why big bubbles happen, and why also the fastest moves are at the end of the bubble. The biggest, fastest, most convex moves are at the end. In 98, 99, 2000, we saw upside calls for almost 2.5 years explode higher in vol. I want to be clear. It was the easiest trade on the planet. Vols were too low on the calls. You would just buy them every day and sell stock. And if the market went up, it would go up big and you'd make a ton of money. And if the market went down, those vols would go up again. And so what happened is implied volatility just expanded dramatically, went up into the last year of the rally. For the full year, the vol just kept going up and up and up and up under the rally. And it became a megaphone. What happened is that drove more volatility in general. So we got massive pullbacks and then massive rallies. This is what a bubble looks like. We are entering the bubble phase, right? So we have entered, I guess I should say. And I want to be clear, does that mean the market's going up or down? Well, likely going up, but it will end spectacularly when it does, and it will go down big. Okay, that's the reality. But people are going to say, well, you're playing both sides, Jim. Choose a side. I don't have to. You can go buy calls, sell stock, delta neutral, not pick up or down, and make money in both directions at this point. That's what I'm telling you. That right call is right side of that distribution is way too cheap. So you asked specifically about crypto and market structure. And by the way, there's call skew in crypto, so it's less cheap there, right? We're talking more equity indexes, et cetera. But there's a reason it's the right skewed in crypto right now. And let's get into crypto. So that's in general, right? So markets and liquidity are going to drive a reflexive loop likely on the right tail when this, if and when this thing gets going, right? Which I think is likely at this point. Importantly, there's no bigger driver of liquidity in the world, bigger than the Federal Reserve, bigger than the Treasury, bigger than the government. I mean, bigger than the economy itself. The biggest driver is the market. The market itself creates more liquidity than anything else on the planet. Now, the Federal Reserve and Treasury can manipulate through saying, hey, we're going to do X or Y, what the market does on the bond side and equity side, which can then drive liquidity. But the biggest driver of liquidity is the market itself. And so it's a loop. And so that's the other thing. I want to be clear. We had more businesses created, more income created. We were in a budget surplus in 98, 99 because the market was going up. And what happened when the market went down? 95% of businesses went into recession. And people always think it's secondary, that the markets are secondary. They reflect the economic realities. I'm here to tell you it's the other way around. I mean, it's a loop, but the bigger driver is actually the market itself and the liquidity itself. And so because it's a loop, if markets go up, you get more collateral, more leverage, more investment, more economic outcomes, more SPACs, more all the things, right? And now, great irony is people also get more short into that. That also drives more short squeezes at the end of that, at the end of the outcome. But anyway, that's the big picture to drive into crypto and precious metals, which I'll put in the same bucket right now, even though they're different things. I've said this on other venues, but I really want to hammer this point home. Very few people understand that it's probably the most important thing in finance, period. $500 trillion of assets on one side, which are equities, bonds, private equity, private credit, venture capital, real estate, I would put in that as well, long assets, right? And then you have, as of 3 years ago, only $4 trillion of what I'd call alternatives, okay? And I'm not talking about private equity, private credit, because those aren't alternatives, right? What are those alternatives? This is, again, as of 3 years ago, and then we'll update it to now. That $4 trillion was crypto, hedge funds, structured products, and precious metals. I say 4 trillion because even though gold was 7 trillion at that point 3 years ago, only 1 trillion was outside of sovereign vaults. Okay. That number is now almost $15 trillion in 3 years, at a tripling of those. People don't understand why. It's because you have 500 trillion on the other side with no way out.
Yeah, you got to buy something, right?
So I don't care that's gone from 4 to 15. Right? This is with the market going up, right? And the risks themselves not presenting themselves. These are with the early adopters who are managing risk and trying to get more non-correlation. Okay. But importantly, those investments, some of them, like the structured product hedge fund in particular, have dynamic structural effects on the underlying assets themselves. And that's part of what we're talking about with the bond and term loans and everything else. So the structured products and how those are tied in. This summer and the hedge fund squeeze and the shorts there and the dry, all those are also very important to this distribution, this outcome. So as it relates to crypto and precious metal, I mean, I don't know how you can look at that supply and demand imbalance. Again, voting, are there more buyers or sellers, and not be long convexity there. I don't care what the price is within reason. Okay. So that's what's driving the tripling in precious metal and gold in 3 years. That's what's driving the tripling in precious Bitcoin and crypto the last 3 years. And for the early adopters, the 1000x, right, for the last decade. But importantly, I'll leave you with that, like that early innings still for all of those assets, and early innings for the growth of hedge fund structured products as well, and the effects that they have. So making what we're talking about all the more relevant and important.